Investors around the world have realised that fighting inflation is going to be difficult. It's causing enormous volatility in the markets as there's a fear out there that economies could go into recession. Australian market, it's down about 12% year to date, but relative to other markets, that's not too bad. International markets are down like 18%. The US market, that's firmly in their territory. It's down by more than 20%. And the NASDAQ, where the high-tech stocks reside, that's down by over 30%. There's a stack of content out there on volatility and how to deal with it. And they all come to the same conclusion. Look, in the end, it's all going to be okay. So let's get that elephant in the room out of the way right now. They're right. In the long run, volatility is just a normal part of investing, and market downturns happen quite regularly and everything's okay. Now that's fine for some, but if you're about to retire or you're in retirement, this is a very unnerving period. So let's have a look at 5 strategies that you can use to deal with this volatile period. First off, try to tune out the noise from financial media. The financial media is full of fact and fiction. Fact, well, that's when they report on what happened yesterday. It's when they report on company earnings or company announcements. And then there's fiction. Fiction is when they interview a fund manager or an economist and they ask them what do they think about the future. No one knows what the future is. So try to tune out the fiction from the fact in financial media. Secondly, timing markets is very hazardous to your future wealth. Now, everyone knows this, but nonetheless, people can't help but think, maybe I should get into cash. If you're thinking now you should be into cash, it's way too late. Going into cash would have happened way back in December 2021. Timing markets means you've got to know when to get out at the top of the cycle and when to get back in at the bottom of the cycle. No one knows how to do. Warren Buffett has said, I don't know how to time markets and I don't know anyone who does. The third point is it's important to realize that for every seller, there's a buyer. In other words, even in a market downturn, there's someone on the other side of the trade thinking, I think that this stock is now at a fair price and I'm going to buy it. Typically, they're the long-term investors. Number 4, diversification is crucial. Now, you do hear that in market downturns, people will say diversification is dead because everything's going down. But over the long run, that's certainly not true. Markets perform differently in different times, and asset classes perform differently in different times. And the 5th point is that discipline is rewarded. We know it's difficult just to look at the markets fall and not do anything. But by staying disciplined, sticking with your plan, will see you enjoy those long-term returns that are coming. Look, market volatility is a very unnerving period, particularly if you're approaching retirement or in retirement. But remember these 3 things. Number 1, market corrections are not uncommon. They happen all the time. Number 2, they don't tend to last very long. And number 3, markets recover fully from market corrections, typically within 1 to 3 years. As always, a financial advisor can help you put in place a plan to reach your long-term goals.